Hey, good morning. Let's go over today's trade plan. So in the overnight session, we saw that sellers were active above Friday's range and ended up pushing ES back down towards Friday's VPOC. And at this point, we're trading even below that level. So heading into the open, we know that the overnight session has been more dominated by the sellers. We're going to be using 53.75 to 55.75 as the micro bull bear zone to establish very short-term directional bias off the open. If we're holding below it, we know that sellers are more in control, at least on the smaller time frames, and it could result in a pullback and test of the 45 to 48 initial support, where buyers can still be active. Because at this point, we are overall, we've seen some pretty decent buying over the last week, and buyers have been very dominant. But heading into this week, we have the FOMC announcement on Wednesday, and we have a couple of econ reports later today, pending home sales and the Dallas Fed manufacturing survey. But these aren't big market movers, and the next big catalyst is really the FOMC announcement. So the early part of the week, we could see more of a balanced market on the larger time frames. So it doesn't mean that we're heading big one way or the other, but we may just see continued kind of two-sided movement within a range. And for that reason, the overall bias on this market is relatively neutral for now, because any pullbacks can still attract buyers at support, and at the same time we have these pockets of resistance on the upside where we have been seeing some pretty decent reactions. So it requires a pretty flexible and nimble mindset on the day time frame, where you understand the big picture but can adjust and adapt your bias based on what you're seeing in real time on the day time frame. So again, heading into the open, 53.75 to 55.75 is going to be a good tell as far as which side is really in control on the day time frame. Holding below it brings 45 to 48 into play. That's still a spot where buyers can be active. Below that, we have support at 43, and then really key support at that 39 to 41, which we're going to be using as the bull bear zone on the slightly larger time frames. So in the event that we break 39 to 41, that's where there could be a bigger picture, or at least a larger time frame shift in the bias. Until then, 45 to 48 can still attract buyers, 43 can still be defended, and 39 to 41 can still be defended, and we could just balance within a range. On the upside, we have resistance at 59 to 61. We have the prior close, a gap fill at 59.75. In the event of a directional breakout above 55.75, this zone may not really provide much edge, and could just be a short-term pause point before we head higher. We have the overnight high, 65.75, and then the initial resistance zone, 68 to 71. This is an area where sellers could be active on first test at the overnight high and at 68 to 71. So, at this point, we're looking at a scenario where we could get a pullback to 45.48 and then perhaps start stabilizing a bit, heading higher. If we break 45 to 48, then that's a red flag, and sellers are being more dominant. That brings 43 and 39.41 into play. That's really the final line in sand for buyers if we are going to see some of those higher prices. If 39.41 breaks, then below that we have a pocket of support, 32 to 34. It's not major support. The next really key support is down at 27 to 29, and then 20 quarter to 22 quarter. Now that would be a pretty extended sell-off, and we'd have to see some pretty strong internals pointing to the downside in order to get that kind of move. Given that we don't have any major economic catalyst and we're heading into FOMC in a couple of days, I don't think we're going to get a major sell-off. I think if anything, it'll be more of a consolidation and balance type market. But again, that's something we do have to gauge in real time. And if we're seeing some strong downside momentum and very negative internals with a very weak advanced decline, then it's better to focus more on the short side, or at least be cautious on long setups, which means that go for the best trade location, instead of taking any aggressive prices. Wait for the prices that are towards the bottom of the support zones, and that way, at the very minimum, you're very likely to get price edge off of those lower areas of support zones, and in the short term, that can definitely provide a bounce. So, for example, 45 to 48, lower to middle of zone could be a better spot if we're seeing some strong downside momentum and very negative internals. But, we will have to take it step by step. So we'll see the reaction at 45 to 48. From there, if we can get back above 53.75 to 55.75, then we know that, buyers are back in control. If, the market continues to fail and hold below 53.75 to 55.75, then you know that eventually even 45 to 48 could break. So we're just going to have to take it, step by step, because, we've seen a really strong rally over the last week, and, that tells us that there is some strength in this market, but at the same time, we're hitting some pretty decent resistance areas where, every time, basically on every first test of resistance, throughout this whole up move, we've seen some pretty decent reactions and some nice pullbacks. So, for that reason, you just have to be very flexible and nimble on the day time frame. And if you can do that, then there's a lot of opportunity. Then there are some really nice setups available on the day time frame. The other thing is, so far we're running on below average volume, which typically results in a in narrower range. In this expanded volatility environment, that narrower range can still be quite easily 15 to 20 points. So just keep that in mind. Aside from that, let's just see how the market reacts to 45 to 48 and 53.75 to 55.75, and we will take it from there.